Okay, dear students, let's start the practice questions on pricing. Okay, so in today's lecture, we'll be doing the past paper question, and the topic is pricing. And after that, inshallah, from next class, we'll start a new chapter, relevant costing. Very interesting and easy as well. But let's right now just focus on this lecture, practicing past paper question on pricing. So let's read the scenario. ALG company is launching a new innovative product. If you just recall the pricing chapter, when you are launching a new innovative product, so such factor actually helps you to go for price skimming. A computer game onto the market and is trying to decide on a right launch price of the product. Okay. The product's expected life is 3 years. Again, the short life cycle, also having a short life cycle, also, I would say, goes in the favor of price skimming. Given the high level of costs which have been incurred in developing the product, ALG wants to ensure that it sets its price at a right level and has therefore consulted a market research company to help it to do this. Okay, they're asking a consultant company to do the research for them. The research which relates to similar but not identical products launched by other companies has revealed that at a price of $60, annual demand would be expected to be 250,000 units. If the price is $60, demand will be 250,000 units. However, for every $2 increase in selling price, demand would be expected to fall by 2,000 units. So there's a price elasticity of demand. If the price changes by $2, demand changes by 2,000 units. For every $2 decrease, demand will increase by 2,000 units. Okay. A forecast of annual production costs, which would be incurred by ALG company in relation to the new product, are as follows. Annual production units, 200,000, 250,000, 300,000, and 350. We have direct material, we have direct labor cost, we do have overheads as well. Using high-low method, what are the total variable costs for an annual demand of 250,000? Using high-low method, what are the total variable costs for an annual? So basically, we need to find out first, you have to identify the variable cost per unit, then simply multiply by 250,000. How to identify the variable cost per unit is very simple. Please look at this. At 200,000, the direct material is 2.4 million. Simply use the calculator. 2.4 million divided by 200,000. Let's see what we are getting direct material per unit. Because the definition of the variable cost is, which remains same on per unit basis, but it varies on total basis. So 2.4 million divided by 2 lakh, I'm getting variable cost of material 12 per unit. 12. Now let's check this one. 3 million divided by 2 lakh 50. 3 million divided by 2 lakh 50. This is also 12 per unit. Now, if you just, we know the direct material cost is 12 per unit. So you can do this 300,000 multiplied by 12. If you're getting 3.6 million. Yes, we are getting. So simply direct material is per unit 12. Material cost is $12 per unit, and it's a variable cost. Direct labor, please, students, I want you to use your calculator. 1.2 million divided by 2 lakh, you will get 6. 1.5 million divided by 2 lakh 50,000, you will get 6. 1.8 million divided by 3 lakh, you will get 6. So it means even you check here, 2.1 million divided by 3 lakh 50, you will get 6. So direct labor cost is again obviously variable and it is 6 per unit. So direct labor cost $6 per unit. Now this is important, very overheads. 1.4 million divided by 2 lakh, you will get 7. 1.4 million divided by 2 lakh, you will get 7. Now look at this. Overheads are given to me 1,550,000. If you divide this with 2 lakh 50, we are getting something different. 1,550,000 divided by 2 lakh 50. See, the first one was 7. Here I'm getting 6.2. How did I get 6.2? 1,550,000 divided by 2 lakh 50,000. So I'm not getting 7 per unit. So simply the information of overheads which examiner has given, obviously it is not a fixed overhead. How do I know? Because overheads are changing. At 200,000, it is 1.4 million. At 2 lakh 50, it is 1.55 million. At 300,000, it is 1.7 million. So that's for sure. The given overheads, they are not fixed. Second, they are not also variable. So simply you can say that the overheads which examiner has given us, this is semi-variable. Now, whenever you come across a semi-variable cost, how will you find out the portion of variable and the fixed cost? You have to use the high-low method. Repeat. We use high-low method to split the semi-variable cost into variable and fixed cost. And right now, obviously, we need variable overhead per unit because we have been asked to calculate the variable cost for the 250,000 units. Let me repeat again. Please, student, look at the data. Overheads are 1.4 million when the units are 2 lakh. They are 1.55 million when units are 2 lakh 50. They are 1.7 million when units are 3 lakh. So it is quite obvious. It is not the fixed overhead because they're changing. And they are not variable as well, because when I divided 1.4 million with 2 lakh, I got 7. When I divided 1.55 million with 2 lakh 50, I got 6.2. So it is not, because the variable cost means which remains same on per unit basis. I'm getting different answer of the overheads on per unit basis. So one, it is not the fixed overhead. Second, it is not the variable overhead as well. It's a semi-variable overhead. So how to split the semi-variable cost into variable and fixed? You have to use the high-low method. Now the question is how to use the high-low method. It's very simple. Let's use the formula. Variable overhead cost per unit. Variable overhead cost per unit is equal to high-low method. Just check at a highest activity level, what is the cost? The highest activity level is 3,50,000. Highest activity level is 3,50,000. And the overhead cost at highest activity level is 1,850,000. Repeat. First check what is the cost at highest activity level. In this question, highest activity level is 3,50,000. At 3,50,000 units, Overheads are 1.85 million. Now, minus the lowest activity level, minus the cost at lowest activity level. Lowest activity level is 200,000. Now, what is the cost at lowest activity level? It is 1.4 million. So simply repeat. How do we use high-low method? Highest activity level minus the lowest activity level. Cost at highest activity level cost minus the cost at lowest activity level. So repeat, what is the formula of high-low method to calculate the variable cost per unit? Highest activity level cost at highest minus the lowest activity level and minus the cost at lowest activity level. Now let's see. What are we getting per unit? 1.85 million minus 1.4 million. In the denominator, we have 3,50,000 minus 200,000. So from 350, I'm getting the answer of the numerator 4,50,000. Answer of this numerator, I'm getting 4,50,000. Answer of the denominator, I'm getting 1,50,000. So obviously 4,50,000 divided by 150 will get 3 per unit. So variable overhead cost is $3 per unit. So here comes the total variable cost per unit. 12 plus 6 plus 3. It is 21. And we need to know what is the total variable cost at 2,50,000 units. So 21 multiplied by 2,50,000. 21 multiplied by 2,50,000. I'm getting 525,000,000. Delta. Okay, now. What are the total fixed overheads? Very simple. We know how to split semi-variable cost into variable and fixed by using high-low method. From the total variable overhead, if you deduct from the total overheads, if you deduct the variable overhead, so obviously the balancing figure will be fixed overhead. You can take any activity level, it's up to you. Either work on highest activity, lowest, it does not matter. Fixed cost will remain same. So we need to find out the fixed overheads. Just take the total overheads. Let's say I'm taking total overheads at 200,000 units. Even you take at 350, no issue at all. Total overheads at 200,000 units, it is 1.4 million. Less variable overhead. 200,000 units multiply by 3. It is 6 lakh. So basically fixed overhead is 800,000. Now, for example, if someone is using, let's say, highest activity, there's no issue at all. At highest activity level, you can check this. Your total overheads are 1.85 million. 3,50,000 units multiplied by 3. So 350 multiplied by 3. 1,050,000. You will get 8 lakh. So either you take total overheads at lowest activity level or highest, any activity. Your fixed overheads will remain same. So how to calculate the fixed overheads? Take the total semi-variable cost and at any activity level. Then simply deduct the variable cost. So obviously the balancing figure will be the fixed overheads fixed cost. Repeat. Take the total semi-variable overhead at any activity level minus the variable overhead. You will get the fixed overhead. Okay, now let's go ahead. If the marginal cost is 21, which we have calculated, MC, what is the optimum profit maximizing selling price to the new product? Wow. Now you need to know all the steps of demand function. Actually, first you have to make the demand function. P is equal to A minus BQ. Step 1. P is equal to A minus BQ. B is the price elasticity of demand. We know that. Simply change in price upon change in quantity. If the price changes by 2, the quantity changes by 2000. We'll get 0.001. And again, you need to ignore the negative sign. I think we did discuss, if I'm not wrong, in our previous classes. Mathematically, the answer of B will always be negative, but just we ignore that. Okay. So the demand equation is, function is P is equal to A minus 001Q. Okay, now step 2 is to find. Step 2 is find A. Logically, the step 1 is to find B. Now step 2 is find A. We have one relationship, that is at the price 60. If the price is 60, the demand is 2,50,000. They have given us. When the price is $60, the demand is 250. So we need to find out the price where demand is going to be 0. And that is A. Step 2 to calculate A. When the price is 60, demand will be 2 lakh. It's going to be 001. Just a minute. When the price is 60, the demand is going to be 2,50,000. So 60 is equal to A minus 2,50,000. So 60 plus 250, 310. Basically, if the selling price becomes 310, demand is going to be 0. Now the demand function is here. A is equal to P is equal to A minus BQ. Now convert this demand function into MR. MR is equal to A minus 2BQ. So marginal revenue is equal to 310. Just 0.001 multiplied by 2. You will get 0.002Q. And profit is maximized when MR will be equal to MC. Or MC is equal to MR. MC is 21. From here, first we'll calculate the quantity. Once you have calculated the quantity, you will go back to the demand function to calculate the price. 310 minus 21 is equal to 0.002Q. Let me use the calculator. 310 minus 21. I'm getting 289 divided by 002. And let's see what are we getting. I'm getting 1,44,500 units. Now go to the demand function. P is equal to A minus BQ. Q is 1,44,500. So this will be the price where the profit is going to be maximum. And let's see what are we getting. I'm getting 165.5. So students, it is highly recommendable that you should know the steps. Step 1, try to make the demand function P is equal to A minus BQ. B is equal to change in price upon change in quantity. Mathematically, the answer of the B comes in negative, but we ignore the sign of the negative. So the demand function is P is equal to A minus 0.001 Q. Then step 2, find A. A is the price where demand is 0. So examiner will give you any price and quantity relationship. For example, if the price is 60, the demand is going to be 250. A, we are getting 310. The interpretation of 310 is, if you set the selling price 310, demand is going to be 0. Profit is maximized when MR will be equal to MC. Demand function, just convert that into MR. Marginal revenue is equal to A minus 2BQ. So we just multiply this with 2. It will become MR is equal to 310 minus 0.002Q. Then we have equate this, calculated the Q. After calculating the demand, after calculating the quantity demanded, go back to the demand function to get price. So now come here. The sales director is unconvinced that using an optimum profit maximizing selling price is the correct one to charge at initial phase of the product. They believe that at a high price should be charged at launch to take advantage of those customers prepared to pay high prices for the product. Which two of the following statements are true? The sales director is suggesting the market skimming strategy. Yes. The strategy could be a suitable one for ALG company as its product is new and different. Yes. Where the products have a long life? No. It is in fact written. Product is a short life. And second, in long life, price penetration is suitable rather than, I would say, skimming. There is no barrier to the entry in case of what? ALG company. Actually, when there's a price skimming, it actually encourages the new entrants to come. It will encourage the company to come into the market. So let's go for. Okay, they're asking there is no barrier to entry in case of ALG company. Now let me tell you. They're saying no barrier to entry. Basically, number one, when you are charging high prices, so definitely charging high prices means it attracts competitors. Number two, when we can say there is no barrier, basically, if you have a patent, that patent works as barrier for the new entrants, number one. Number two, if high investment is needed to develop the same product which you have produced, that also works as barrier. It is written in the question that ALG company has faced a high development cost. So actually high development cost works as barrier for the new entrants. So here they are saying there's no barrier to the entry. No, there's a barrier. Obviously, only one factor is not a barrier. There are so many factors, they work as barrier for the new entrants. If you can patent your product, it works as a barrier. In fact, price penetration works as a barrier. Obviously, there's no price penetration agreed. There's no patent thing agreed. But high investment works also as a barrier. And it is written in the question. ALG company faced a high development cost. So high development cost is a barrier for the new entrants because everybody is not willing to spend such a high development cost. So why statement number 4 is incorrect? Because barrier exists in case of ALG company and they are saying there's no barrier. So there's a barrier. The barrier is high development cost. That is why this one is not correct. Only 1 and 2 is correct. ALG company is truly unique, can only be used in conjunction with another one of the price business product. When your product will be used with another, so there's a complementary product pricing. Students are entitled to, if you are giving discount to one class of customer, not giving discount to other, that is price discrimination. Which of the following pricing study could be used? Market skimming, yes. Complementary product pricing, yes. Price discrimination, yes. Not this. When my product is unique, different, why would I go for price penetration? I'll go for skimming. I'm giving discount, small discount to the students. I'm not giving the discount to everyone. So price discrimination. My product will be used with in conjunction with the other product. So complementary product pricing, 1, 2, and 4. Let's see what is the option. Option is C, Charlie. Jewel company. Let's see. Another good question. Jewel company is setting up an online business that is import and selling jewelry, headphones. So they are setting up a business, online business, and import and then selling jewelry, headphones. Wow. The cost of each set of headphones varies depending on the number of purchase, although they can only be purchased in batches of 1,000 units. So you cannot buy less than 1,000 units, okay? One batch means 1,000 units. You cannot even go for 1.5 batch. You will have to buy in batches, and one batch means 1,000 units. It also has to pay import taxes, which vary according to the quantity purchased. Obviously, import taxes, they are not same. They varies according to the quantity you are buying it. Jewel company has already carried out some market research and identified that sales quantities are expected to vary depending on the price charged. Consequently, the following data has been established for the first month. Number of batches import and sold. 1. Average cost per unit including import taxes, it is 10. If you're going for 2, your average cost will be 8.8. In case of 3, this. So we can see that. But after 4, the average cost remains same. Total fixed cost is 10,000. When you are dealing only one batch, your fixed cost is 10. You're dealing in 2 batches, it is 10. But when you go for 3 batches, it becomes 12. When you go for 4 batches, it is still remain 12. 5 batches, it is 14. So your fixed cost is stepped fixed cost. Actually, step fixed cost means which remains same for a certain range. As soon as you are producing, your activity level increases, then step fixed cost also increases, which we can see here. If you are just dealing in one batch, your fixed cost is 10,000 per month. You are dealing in 2 batches, your fixed cost is still 10,000 per month. But as soon as you exceed 2 batches, you go to 3 batches, your fixed cost becomes 12,000. If you are at 4 batches, it is 12. As soon as you go for 5, it becomes 14. So we can see that it's not the same at every level. So it's a step fixed cost. Expected selling prices per unit. We have 20. Obviously, in order to sell more units, you have to reduce the prices. Fine. Most of the jewel company total fixed costs are, they have also given a step fixed cost. Most of the jewel total fixed costs are setup cost. Fine. Earphones. Jewel company is also producing luxury earphones. Has entered 2 different new markets. In the USA, it is initially charging low prices. Low prices means price penetration, USA price penetration, as to gain the rapid market and share while demand is relatively elastic. So price penetration will suit you. In Europe, it is initially charging a high prices, price skimming, as to earn maximum profit while demand is relatively inelastic. Then price elasticity of demand is less than 1 in case of inelastic. Elastic means price elasticity of demand is more than 1. And logically, we have already discussed, when the price elasticity of demand is more than 1, it is elastic. Reduce the prices. That you should be doing in USA. If price elasticity of demand is inelastic, increase the prices, that you should be doing in Europe. So Europe, I would say price is skimming. USA price penetration. Market research has revealed that maximum demand for the Joule earphone is 72,000 units per year. The maximum demand which is possible, that is 72,000. It cannot increase 72. And that demand will reduce by 8,000 units of every $5 that the selling price increase. So that will give me the price elasticity of demand. Simply change in price by $5 brings change in demand by 8,000. Joule company has calculated profit maximizing level of sale for its earphone for the coming is 32,000. So we know that the profit is maximized when MR is equal to MC. At this level, examiner has already found the quantity, that is 32,000 units. We know that according to the economist, profit is maximized when marginal revenue will be equal to marginal cost. At that point, examiner has already found for us the quantity demanded there, 32,000 units. Okay. Now let's see. How many batches should Joule company import and sell to the nearest whole batches? Now they are simply asking, how many batches? See, when this is a question that how many batches Joule company should import and sell. So you have to find out where they can generate the maximum profit. Obviously, where they can generate the maximum profit, they will go for that. Come here. Someone is asking how many batches Joule company should import and sell. So how will you answer? Obviously, at different batches, we will calculate the profit. Where profit is going to be maximized, where profit will be maximum, we will advise go for those number of batches. Now let's come here. And one batch means 1,000 units, which we know that. Now, please, let's see. Average cost per unit, including the import tax, is 10. Expected selling price is 20. Okay. It means if I just minus 10 from the 20, I can say I'll get the contribution 10. How to calculate profit? I'll tell you. Profit is equal to 20 minus 10, I'm getting 10. One batch means 1,000 units. Logically, this will give me the contribution, but I need to find out the profit minus the fixed cost. Fixed cost is 10,000. Logically, the profit is 0. So if you're dealing just in one batch, means 1,000 units. So logically, your profit is 0. Otherwise, there's more way to calculate the same thing. If someone takes 20 multiplied by 1,000, you will get a revenue of 20,000. Your variable cost is 10 multiplied by 1,000. You will get a variable cost of 10,000. Revenue 20,000, variable cost 10. From 20, you will deduct 10, you will get a contribution 10 minus the fixed cost 10. So profit is 0. Now let's come here. If you go for 2 batches, selling price will be 18, variable cost is 8.8. 18 minus 8.8. Let's see what profit I'm getting. 18 minus 8.8, I'm getting 9.2. But this time we are selling 2 batches, means 2,000 units. 9.2 multiplied by 2,000, I'm getting 18,400 minus the fixed cost, which is 10,000. So how much profit we are getting? 8,400. So if Jewel Company deals with import and they sell 2 batches, they will be generating a profit of 8,400. In case of 3 batches, selling price is 16 minus 7.8. That difference will give me the contribution. 16 minus 7.8, I'm getting 8.2. But now we are selling 3 batches, means 3,000 units. 8.2 multiplied by 3,000. 8.2 multiplied by 3,000 gives you 24,600. So the total contribution is 24,600 minus the fixed cost. This time the fixed cost is 12,000. This time your fixed cost is 12,000. So let's see how much profit they will be generating. We are generating 12,600. In case of 4 batches, the selling price is 13, variable cost is 6.4. So 13 minus 6.4. 13 minus 6.4, I'm getting 6.6. But now we are dealing in 4 batches. 4 batches means 4,000 units. 6.6 multiplied by 4,000. I'm getting 26,400. So 6.6 multiplied by 4,000 gives you the contribution 26,400 minus the fixed cost, which is 12,000. I'm getting a profit of 14,400. In case of 5 batches, the selling price is 12 minus 6.4. 12 minus 6.4, I'm getting a contribution of 5.6. But now we are dealing in 5 batches, means 5,000 units. 5.6 multiplied by 5,000, I'm getting 28,000. I'm getting 28,000. How much we are getting? I'm getting 28,000. Now, 5.6 multiplied by 5,000, I'm getting a contribution of 28,000. But now the fixed cost is 14. So the profit is 14,000. So it can be seen that the maximum profit is 14,400 at 4 batches. So when you go for 4 batches, you will be generating the maximum profit. So highest total profit is at 4 batches. Which of the following statement regarding Joule's fixed cost are correct? Joule fixed costs are a step, yes. Increasing batch size from 1,000 to 2,000 units would dramatically reduce the setup cost and increases what? Profit. Wow. Increasing batch sizes from 1,000 units to 2,000 units. If you increase the batch sizes from 1,000 units to 2,000 units, that would reduce setup cost dramatically. Of course, now instead of 1,000 batches, 1,000 size of the batch, we are working in 2,000. So definitely your setup cost will reduce. Increasing the batch size from 1,000 to 2,000 would dramatically reduce the setup cost and increase the profit. This second statement is also true. Why it is true? Please try to understand. What is the reasoning behind that? Only 1,000 batch, only the batch size has to be 1,000 units, because after each production run, you have to bear the setup cost. So why not? Why can't we increase the batch size? If we can increase the batch size, then obviously management will focus on that, how to reduce the setup cost. So if the batch sizes increases, so definitely the setup cost will reduce. When the setup cost reduces, so definitely profit will increase. So logically, both the statements are correct. The following statements have been made about the tabular method using establish an optimum price. We have discussed this tabular method previously, of course. Which of the following statements, because one approach is MR is equal to MC, another is tabular method. Which of the following statement regarding Joule fixed cost are correct? With the tabular method, there must be a consistent relationship between price and the demand, as well as a close relationship between. Actually, this is false. Why it is false? Basically, when you say that in a tabular method, there must be a consistent relationship. So it is not in the tabular method. In demand function, yes, there's a consistent relationship. So you will get a consistent relationship in demand function, that is P is equal to A minus BQ. But in tabular method, there is no such consistent relationship. The tabular method is only suitable for companies operating in monopoly. Yes, it is only suitable because you are in a position to charge whatever prices you want to charge, and then you keep checking. If I keep reducing the price, where I can get the maximum profit. Beta. Which pricing strategy is Joule using in each market? Penetration in the USA and skimming in Europe. Yes. What is the optimum selling price at profit maximizing level of sales? Okay. Now let me explain. We know that profit is maximized when MR is equal to MC. At this level, what should be the price? They are asking. Read it again. What is the optimum selling price at the profit maximizing level? And at this level, they have already given us the quantity, which is 32,000 units. At MR is equal to MC, examiner has given 32,000 units. You can see that. Come here. Joule company has calculated that profit maximizing level of sales for its earphones for the coming year is 32,000 units. At 32,000, at MRs is equal to MC, the quantity demanded is 32,000 units, which examiner has already solved for us. But we need to find out the price at MR is equal to MC. So we can do that, no issue at all. Let's go stepwise. Step 1, P is equal to A minus BQ. Okay. B. It is written in the question, if the price changes by 5, demand changes by 8,000. So logically, I'm getting 0.000625. Again, we will ignore the negative sign. So P is equal to A minus the B is 0.000625Q. Okay. Now the next step is to find A, the price where demand is going to be 0. The price where demand is going to be 0. Find A. Next step is we need to find A where the demand is going to be 0. Okay. For finding A, the price where demand is going to be 0, we need to put the relationship between price and quantity given already which exists. Like at what price, what will be the quantity? Just put that, you will get A. Now in this question, examiner has not straightforward given us any relationship, but one relationship is still there. Question says the maximum demand. Maximum demand is given here. Question says the maximum demand. Market research has revealed that the maximum demand for jewel earphone is 72,000 units per year. So the maximum demand, okay, means cannot be more than that. That is 72,000. Maximum demand will be 72,000 units. Now, please listen to me carefully. If you keep the price 0, so obviously demand will be maximum. Maximum. Obviously, price is 0. So you can achieve the maximum demand, which is 72,000. I have the relationship now, price and demand. I can use this relationship in demand function to calculate A. 0 is equal to A minus 0.00625 into 72,000. Let me use the calculator. 0.00625 multiplied by 72,000. I'm getting A minus 45. So A is going to be. It means if you keep the price 45, your demand will be 0. If you keep the price 45, your demand will be 0. Okay. P is equal to A minus BQ. Now, examiner has already found quantity demanded at MR is equal to MC. Here, examiner has found the quantity demanded, which is 32,000 units. Examiner is asking us the price. So very simple. Use the demand function. P is equal to 45 minus 0.00625 multiply by 32,000. Let me use the calculator. 0.00625 multiplied by 32,000. So I'm getting P is equal to 45 minus 20. So simply, the maximum price is going to be 25. So the maximum price is 25. Now, students, please listen carefully. We have completed the pricing chapter, and you people might have noticed that we are discussing each and every concept of every chapter, including, I would say, each and every line of the theory. I have not escaped even a bit of theory, which is obviously in the syllabus. Because how we are doing it, we first discuss all the concepts, then each and every theory relating to that topic. Then we do our small example questions, and finally we go for past papers questions. And obviously, I have given you plenty of homeworks as well. And I'm also discussing those homeworks as well with you. So students, all you need is just follow my instructions properly, which I have given you. I can guarantee you, I can assure you, you can easily pass PM in the first attempt with the flying colors. Because we are discussing all the concepts, number one, each and every single word of the theory as well we are discussing. We are doing practice questions, we are doing past papers. So what is left? I'm giving you homework as well, which you are doing it and we are discussing it. So what is left? Nothing is left. Just follow my steps. You will, I can assure you, I can guarantee you, you will pass this PM in the first attempt. And in fact, you can break the record of my 85 marks of PM. So thank you very much for watching this lecture.